So we are going to start on this stock valuation LIFO. That's our next one. Now, this one is based on the principle that materials entering production, the materials that are being sent to the factory, are those that are most recently purchased. The ones that are most recently purchased. So, in other words, what we are saying is that the materials entering production are units issued at the prices at the most recent purchase price. Okay, material units issued should carry the cost of the most recent purchase, meaning that our closing stock is composed of the earliest or the oldest units, all valued at the oldest purchase prices. When I say oldest, the earliest. Of course, there could be some units that have just come in. They may not be enough, but again, you may touch onto those that came in before, just immediately before. So all in all, last in, first out, recently purchased is what we give you. There are advantages cited on this method, and one of those is that the cost of materials issued to production will fairly reflect the current market value or the cost. So meaning that the products that are coming out of the factory are reflecting the inflationary tendencies. Yes, because as I mentioned, especially in volatile economies, less developed economies where inflation is not managed well, you find that each and every day prices are going up. So the products will reflect what is happening in the environment. And again, as an advantage, we're saying that the method is appropriate for matching cost and revenue. Yes, cost and revenue. The current costs vis-a-vis the revenues that you are getting. The method is most suitable when prices are rising. Yes, as I've mentioned. And from the perspective of the accountants or managers, it overstates the cost of production, puts you into a position where you can understate your profits and thus have a lower tax liability. So for tax planning purposes, some of you may ask you that, you may get a client who may ask, how can I best manage these taxes? If where you are, the tax jurisdictions or the tax laws do not prohibit use of this method, you can advise your client to use this method. It will automatically do the magic. It will automatically do the magic. The disadvantages are almost obvious. It's very hard to explain. Why would you give me the recent units? So managers may not understand why you're behaving like that. It doesn't reflect what is physically happening. Very difficult to explain. You see, if you have a manager who's as tough as Lillian, manager who's as tough as Gladys, these managers here, the Sarahs, very tough. They will ask you very tough questions. Why are you doing that? That kind of thing. And as with FIFO, decision making can be very difficult because of the variations in prices. What you'll be advising will not be realistic. Not recognized for tax purposes. Some of the tax laws are very strict. They don't allow you to use that method. They know you're going to lower your profits because of the fact that this method can overstate your cost of production. Higher cost of production, subsequently leading to lower profits. And then we are saying that inventory valuation does not reflect the current market prices and therefore useless in the context of current conditions. Yeah, so it has those disadvantages there. And we are going to use the same figures to discuss how this works. Last in, first out. How does it work? We're going to use Cooper Limited to do this. I'm going to ask Doreen the question you already have. So what I'll do, I'll simply share what I'm going to do with Doreen so that we can manage time. We're going to work it out, and then I'll share on the chat and in the group. I will share. So Doreen, I don't know whether you're there.
I'm there, sir.
So what did you exactly note about this method? What did you take note keenly about this method, last in?
The last in, first out method. We consider the last inventory received in case of issue, what we give out first.
Perfect. You are very attentive. You are very, very attentive. So let me share my screen here so that I can work with Doreen. For the case of the opening stock, that's what we know. We have the 100 units in stock, and that is 20,000. So on the 3rd of May, what happened, Doreen, on the 3rd?
On the 3rd, we received 400 cartons at 210.
We received 400 cartons at 210. So that one is that there I will not disturb you a lot. That would be 100, the original from 1st of May, 400 coming in, the same 104 we did with Elias. So I want to see you how you're going to treat this transaction on the 4th. So what happened on the 4th, Doreen?
On the
Yes, on the 4th. Hope you're not breaking, Doreen.
100. Yes.
We received what?
On the 4th, we issued 200 cartons.
So how are you going to do it?
We are going to issue 200 of the 400 at 210.
200 of the 400 at 210, which is the total of how much?
420.
420.
42.
42. Yeah. Okay, perfect. So what's happening in the stores, Doreen, on the 4th at the end? You see, inventory is the stock you have, unsold, unutilized, unused, idle. That's what you call inventory. So what's happening on the at the end of the day, on the 4th?
On the 4th in the store, we have 300 units, 100 at 200 and 200 at 210.
200 and 210. Perfect. So that's a total of 362,000. Perfect. Yes. 9th, this one we did. 9th, some inventories came in. There were 300. That one we did. So just give me a picture of what's happening in your store at the end of the 9th of May.
At the end of the 9th, I have
the original.
600.
You have 600.
The original 100 and the 300 that has come in.
So that is
212.
Okay, perfect. So that's a total of 600, which is 125. Perfect. Then 11th of May. What happened, Doreen? 11th of May.
11th of May, we issued 400.
So how did you do that?
We are going to give out 300 at 212 and 100 at 210.
And 100 at 210. Perfect. So how is the situation in your stores on the 11th of May?
On the 11th of May, I am remaining with 200, 100 at 200, and 100 at 210.
And 100 at 210. Perfect. So that makes it 200. Okay, on the 18th of May, you received more, which were 100. Am I right? 100 at 240?
Yes, 100 at 240.
Okay, perfect. So just simply add it to those. So you still have the original 100. You see, the original 100, you see the opening stock, the old one, then the next 100, then the new one is 100. Okay, let's do the last issue, which happened on the last day of May 20th. How many did you issue out?
20th of May, we issued out 100 cartons.
Okay, how did you issue this?
We'll issue them out at 240.
At 240, which is 24,000. So leaving you, how is the situation now in the store?
The store, I remain with 200, 100 at 200, and 100 at 210.
100 at 200, the old one, and 100 at 210. So you can imagine that the units we had at the beginning, the cartons we had at the beginning are still there. We are just issuing out the latest. So that's how bad this method is. It's not really reflecting what's happening. So thank you very much, Doreen. So members, what I'm going to do is to share this at once. We're not going to write. I'm sharing this because I want to finish up with the weighted average method. So just give me a minute to share this.